VGT's crushing QQQ by 20 percentage points over 5 years. That's the gap between doubling your money and nearly tripling it. Let's dig into the details. VGT crushed it with 122% returns over 5 years. That's the kind of compounding that transforms modest investments into serious money. But that's not the whole picture. QQQ's 102% return over 5 years sounds strong, but that 20-point gap really adds up when you're compounding wealth. In plain English, VGT finished 20% ahead over 5 years, like race cars on the same track with different engines. It's not just about speed, it's about what's powering you forward. Now let's shift gears and look at VGT's crushing it with 141% returns over 3 years. And here's the kicker. It's actually pulling further ahead over time. Here's the thing though. QQQ's 135% return over 3 years is solid, but it's trailing behind VGT in this tech fund showdown. Let's zoom in on this. VGT's recent performance is solid at 23%. Strong returns without the crazy volatility we've seen from other tech plays. But here's where it gets interesting. QQQ caught up to VGT here, matching its 22% return. Looks like the performance gap between them basically vanished. In plain English, VGT's like a marathon runner who owns the full race, crushing it over the long haul. But zoom into recent miles, nearly neck and neck. Distance reveals who's really winning. Let's break this down further. QQQ's Sharpe ratio of 1.4 means you're getting solid returns without taking on excessive risk. Efficiency at its best. But wait, there's more to the story. VGT's Sharpe ratio of 1.2 means those returns came with proportionally higher risk. You're getting rewarded, but you're paying for it. In plain English, risk-adjusted returns are like a report card. QQQ gets better grades for efficiency, even though VGT scored more total points. It's not just about the gains you make, it's about the risk you took to get there. QQQ's Sortino ratio of 1.9 shows it protects you better when markets drop, delivering strong gains with less painful downside. Let's take a closer look. VGT's Sortino ratio hits 1.7, solid performance, but QQQ manages those brutal downside swings better when markets turn ugly. Now here's where it gets tricky. QQQ's 20% volatility over 3 years means less violent swings. You'll get smoother rides when markets start shaking things up. Let's unpack this a bit. VGT's volatility sits at 23%. Those extra 3 percentage points mean sharper ups and downs for your portfolio. In plain English, VGT's like that extreme roller coaster. You'll feel every twist harder. QQQ's still thrilling, but won't toss you around quite as much. Same ride, different intensity levels for your portfolio. Let's see how this plays out. QQQ's worst drop was 23% over 3 years. Manageable for tech, especially compared to the brutal crashes we've seen elsewhere. Here's what really matters. VGT's 27% crash really stings. Watching your portfolio shrink by that much tests even the toughest investors' resolve. Now let's connect the dots. QQQ bounced back in just 77 days after its worst drop. That's quick recovery, limiting your portfolio pain significantly. But hold on a second. VGT fell harder but recovered just as fast. 77 days to bounce back. That's resilience worth noticing in volatile markets. In plain English, VGT took a harder fall but bounced back just as fast. Like a tightrope walker who wobbles more but recovers at the same speed. Recovery matters as much as avoiding the stumble itself. All right, place your bets. Which tech fund comes out on top here? Let's get into the weeds here. QQQ's worst 5-year drawdown hit 35%. proving even tech's best index isn't immune to serious bear market pain. Now for the real question. VGT matched the downside perfectly. A 35% drop proves both funds sink together when tech crashes hard. But here's where it gets interesting. QQQ took over 13 months to recover from its drawdown. That's a long wait just to break even again. Let's dig into the details. VGT bounced back just 3 days quicker, 402 days total. Basically identical recovery speed despite taking the same beating down. In plain English, both funds took over a year to rebuild after hitting bottom, like watching a building slowly rise from rubble. Tech investing isn't a sprint. You need serious patience here. Now let's shift gears and look at VGT's 0.09% fee is incredibly cheap. You're keeping over twice as much compared to funds charging even 0.20%. But that's not the whole picture. QQQ's 0.2% expense ratio is still low, but VGT undercuts it by more than half. A clear winner on costs. In plain English, expense ratios are like couch change. Seems like nothing now, but those extra pennies compound over decades into thousands lost to fees. Small differences, massive long-term impact. Here's the thing though. VGT is laser-focused on tech. 98% allocation means you're getting pure sector exposure without picking individual stocks yourself. Now let's put this in perspective. QQQ is only 53% tech. The rest is spread across other sectors, so you're getting less pure tech exposure here. In plain English, VGT's the whole tech pizza, pure concentrated technology exposure. QQQ splits the pie with other sectors mixed in. It's really about how much tech risk you're willing to stomach. But wait, there's more to this story. VGT's spread across 325 companies means you're not betting everything on just a few tech giants. It's genuine sector diversification. Here's where the story takes a turn. QQQ's laser focus on just 102 companies means bigger swings. You'll feel every win and loss more intensely than broader funds. In plain English, VGT holds 325 stocks, while QQQ has just 102. That's triple the diversification. With the egg basket approach, VGT spreads risk wider, so any single stock dropping won't hurt nearly as much. Let's take a closer look. VGT's 8% small cap allocation adds exposure to emerging tech companies, giving you access to tomorrow's potential winners alongside today's giants. Upping VGT edges out QQQ with 122% returns versus 102%. But here's the real story. They're nearly identical on risk. Same 35% drawdown, same year-plus recovery time. QQQ just does it smoother. Let's unpack this a bit. QQQ's tiny 0.03% small cap exposure means you're betting almost entirely on established tech giants, not emerging growth stories. In plain English, VGT's got small cap seeds planted alongside its tech giants, while QQQ stays pure large cap. It's classic leaves growing. Younger companies offer explosive potential, but they'll shake you around more during storms. Let's see how this plays out. VGT's beta of 1.4 means it's 40% more volatile than the S&P 500. Bigger swings in both directions. Here's what really matters. QQQ's beta of 1.3 means it's volatile too. 30% wilder than the S&P, but slightly calmer than VGT's wild swings. In plain English, beta works like an amplifier knob. Both funds crank up market swings, but VGT's dialed slightly higher. When markets soar, VGT soars louder. When they crash, VGT crashes harder. But hold on a second. VGT is at 98% tech allocation. This is as pure as tech exposure gets. No mixed signals here. Now let's flip the script. QQQ's not just tech, 53% there, but healthcare, consumer, and communication services balance things out nicely for smoother rides. In plain English, VGT is the devoted partner, exclusively dancing with technology stocks. QQQ's the social butterfly, rotating across multiple sectors. It's pure commitment versus strategic flexibility in action. Let's get into the weeds here. VGT's 325 holdings might look diversified, but with 98% in tech, you're all in on one sector's fate. Now for the real question. QQQ's 102 holdings spread across multiple sectors. Fewer companies, but smarter diversification means you're not stuck riding one industry's ups and downs. In plain English, VGT's all in on tech. One basket, maximum concentration. QQQ spreads the risk across sectors. It's the classic trade-off. Higher conviction means higher stakes, both upside and down. Let's dig into the details. VGT's pure tech focus is crushing it long-term, 141% over 3 years and 122% over 5. That's what concentrated conviction gets you. Here's where things get revealing. QQQ's diversification really shines here. Solid returns with way less drama, showing you don't need wild swings to win. In plain English, here's the trade-off on this seesaw. VGT delivers higher total returns, but comes with more bumps, while QQQ gives you smoother, risk-adjusted performance. Pick your priority. But that's not the whole picture. Both funds tanked 35% at their worst. Tech investing means you're signing up for brutal crashes either way. Let's zoom in on this. Over a year to recover from crashes. That's 400 plus days of waiting and wondering if you'll ever break even. In plain English, here's the reality check. Both tech investments sink to similar depths when markets crash, and you'll wait over a year to recover. It's a stormy ocean where patience matters. Now let's put this in perspective. VGT's 0.09% expense ratio beats QQQ's 0.2%. That 0.11% gap compounds into serious savings over the decades. Let's break this down further. That $1,100 you're saving annually, it doesn't just sit there. It compounds and grows, amplifying your wealth over decades. In plain English, small fees feel harmless, like couch change slipping away unnoticed. But lose those coins between the cushions every year for 30 years? That's real wealth vanishing before your eyes. Here's where the story takes a turn. VGT's 98% tech allocation with 325 holdings means you're betting big on technology. This is pure, concentrated tech exposure. Now let's put this in perspective. QQQ spreads across 102 companies with 53% in tech. You're getting concentrated innovation exposure while the rest diversifies your risk. In plain English, VGT is the aggressive climber taking the steep tech route straight up, while QQQ picks the safer switchbacks with broader diversification. Same mountain summit, different risk appetite required. Now here's where it gets tricky. VGT allocates 8% to small caps, giving you access to emerging tech companies with serious growth potential ahead of them. Let's unpack this a bit. QQQ's got almost zero small cap exposure at just 0.03%. It's all about the big, proven tech giants here. In plain English, VGT's like betting on smaller rockets with explosive potential, while QQQ sticks to the proven spacecraft. Higher upside comes with higher risk. It's the classic trade-off in action. Let's see how this plays out. Both funds amplify S&P 500 swings. VGT's 1.4 beta means slightly wilder rides than QQQ's 1.3, so buckle up for volatility. In plain English, think of it like dominoes falling. When markets drop, these tech-heavy funds tumble faster and harder. Tech amplifies everything, the wins and the losses alike. Now let's connect the dots. So which fund's right for you? VGT if you're chasing pure tech gains. QQQ if you want diversification with your growth. In plain English, here's your investor fit in plain English. VGT is for those who can sleep through 27% crashes chasing maximum gains, while QQQ offers strong tech returns with slightly gentler volatility. Now let's flip the script. Legal stuff, do your homework, consult pros, and invest at your own risk here. But there's a catch. If you want more fun battles like this, hit subscribe. We'll keep showing you which investments actually win each week.